This conference will now be recorded.
Okay, so good morning, everyone. Good morning, good afternoon, good evening, depending on the time zones that you guys are in. And welcome back to a fresh new session, credit risk modeling on scorecards and credit risk modeling. And since yesterday we began our discussion on scorecards, right? So today is the second session that we are kind of talking about the importance of scorecards. So in the discussion that we had yesterday, right? The way we were the way we had started our discussion was around the segment around behavior scorecard. So we discussed the basic concepts of the customer's credit life cycle. From there, we had discussed about the concepts of customer's credit life cycle. We spoke about the behavior scorecards, and from there, uh, the segmentation associated with the behavior scorecards. And from there, we had started talking about the different kinds of possible segmentation, right? So when we are creating different segments, so those segments has not a binding only on risk, but those segments have to be very carefully designed so that they have impacts or they can be leveraged for the strategy as well, right? So that's the reason why we had kind of started off with this the scorecard frameworks, right? Okay, so in yesterday's discussion we had uh, kind of largely spoken about transactors and revolvers. So we had discussed two framework or two possibilities of segmentation for a behavior scorecard. One is in the product type. However, while we discussed the product type, we had said that, or we identified that product type is not a very ideal method of segmentation for behavior scorecards because it you know it cannot give us that insight, or it would not be able to give us the so it would not be possible for it to give us that insight, so that insight, because it is product types are largely dependent on management decisions. So if the management decides to ram down a certain kind of product, and then the scorecard the existence of the scorecard would come into question, right? And hence we decided that any kind of segmentation that should be done or that we plan to do should not be based on, or should be based on factors which are relevant to the individual's behavior, which is relevant to the individual's risk behavior more than anything else, right? So it should always be the behavioral factors or behavioral aspects of a borrower that should be taken into account when a segmentation is being designed, right? So that is something that we have been kind of talking about in the last class. Now, while we talk about the segments that we create for maybe a behavior scorecard or an acquisition scorecard, there is always a deep implication of the strategies that are used. Now, we will be using the acquisition scorecard, the behavior scorecard, to design the behavior of the customer management policies. So, what we need to understand is that how exactly is it that this framework should operate, or how exactly is it that we should understand or assess these segments that we are creating for the behavior scorecards and so on, right? So that's the next part. So that's the part that we will be talking about in today's discussion. We will be exploring the importance of the behavior of scorecards in risk management, and we'll exactly see how this risk management is done. So if I am talking about risk management strategies being designed, then there has to be a business impact analysis. How does that business impact analysis happen? So these are some of the questions that we are going to address. So in today's discussion, we are going to talk about the segments in a behavior scorecard along with the final impact that it has, and how to calculate the business impact of these on the respective strategies that are being that the risk management practices that are being used, right? So we will discuss about accept decline methods, we'll talk about overrides, we'll talk about credit limit increases, credit limit decreases, and so on. So there are a multiple set of factors that we will be talking about in today's discussion. All right. So along with that, we'll also be exploring the basic framework of the scorecards, the acquisition scorecards, behavior scorecards. How are they used to take decisions? And finally, what we'll be talking about is we'll be looking into some key variables and everything. So basically, in short, in crux, we'll talk about the delinquency based segmentation today, and then we'll go to talk about scorecards, their usages in risk management, and what are the different areas they are used, and how exactly is it that these scorecards are used for strategy, right? So that's more or less the set of discussion that we will have today. Now I'll start on from the delinquency based segmentation, because this is a very critical segmentation that happens for scorecards, for any for these media so mostly for behavior scorecards, right? So we had discussed about two broad platforms of segmentation yesterday. One was product based behavior risk, the other set of risk was from card user type risk. Now the second set of risk, the third set of segmentation, or the third source of risk that can arise for a behavior scorecard is a delinquency based risk. Delinquency based risk. The delinquency based risk. Now, very quickly, before we move ahead, we'll recapitulate the fact. So let's recapitulate the fact that what is the purpose of having a behavior scorecard. We know that when we are talking about credit risk, right, and or credit risk management exercises, one thing that we are trying to assess is we are trying to assess the risk profile of the borrowers. If we are trying to assess the risk profile of the borrowers, we want what we are trying to essentially do is we are trying to predict what are the chances of this borrower to default. Now if the borrower is defaulting over the next one year and so on, so we are trying to predict those chances of the borrower to default over a certain set, over a predefined performance period, right? Now while we say this, or while we kind of talk about this, so so the entire risk management practice of a bank is divided into three broad parts, so which comprises of the customer's credit life cycle. So first is the origination stage, where the customers are being onboarded on the books of the bank. Then you have the customer management stage, where uh, the borrowers have been taken on the books of the bank and they are in a process of repaying their loan commitments, right? Now if that's the scenario, then what happens over here is that they are trying to so then what happens over here is the following, that what they are trying to so what you are trying to do over here is you are trying to uh, so whatever you are trying to assess the behavior of the customer, and you are trying to assess how risky is the customer in repaying the loan, and based on his riskiness you are trying to give him, or you are trying to upsell or cross sell products to him. And in terms of that, we had spoken about the concepts of transactors and revolvers, right? And we have seen that the strategies that the bank would associate with each of these two borrowers would be very different. Hence, in terms of behavior risk, we will explore a more fundamental basis of risk distinction by a risk manager, right? Now let's say I'm talking about a transactor and a revolver. A transactor is someone who is paying off their entire balance before the due date or by the due date, and hence no interest is being charged to him. Similarly, for the other borrower, for the revolvers, they are paying the minimum balance or something more than the minimum balance, but not the entire amount, and hence they are generating interest income for the bank. So while the transactors generate the non interest income in terms of fees and other in terms of fees, or they generate fee income for the bank, as and they do not bring along with any default risk because they already pay back every cycle. The revolvers bring a lot of amount of profitability with the bank. Now the question that arises over here is that, given that the borrow for both for a transactor or a revolver, right, it is highly possible that a transactor repayment capability is being affected. So at the behavior stage, we know that we look for the ability of a borrower to repay back, or the likeliness of a borrower to repay back the loans. Now, if that's the case, here, some so over here we need to ensure that the the key source of behavior risk is being addressed. Now, 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 if I'm looking into the transactor-based transactor revolver situation, now, for transactors, it is so be a transactor or revolver, the impact on their ability to pay back will only be identified once they are unable to repay the money, right? So therefore, so even though transactor and revolver shows the creates a risk assessment or helps us assess the risk basis the card usage types, or repayment based on the repayment of the card types, there is one very important factor it does not consider. It does not consider the fact, the ability or the chances of a borrower to miss out on a payment. Now, if that's the scenario, then some alternate segmentation criteria has to be thought about, or something more fundamental, and that is where delinquency based segmentation comes into play. Now let's say that I am a transactor and I keep on paying back my money, but in the last 3 months I have been delinquent at least once, right? So if I have been delinquent once, I have not been a transactor for that month, but for the other snapshots, for the other months, I have been a very dedicated transactor. But the fact that, and let's say there is a revolver who has never been delinquent. So a borrower, a transactor who has been delinquent at least once in the last 3 months can be a more risky borrower. So it can mean that there has something has happened which has impacted his ability to pay, his ability to fund his accounts by the due date, right? So therefore, missing out payments, or the incidences of missed out payments is a very critical indicator for risk management, right? Now, for such purposes, because the entire strategy of a bank can depend on the delinquency status of the borrower. Therefore, a alternate segmentation criteria for behavior scorecards would be the delinquency based segmentation, right? Okay, now let's try to assess the concept of this delinquency based segmentation. Now, delinquency, as we know, is the event of missed out payment. So, if for a given month I miss out a payment, right, then that is an event of delinquency. And the number of days I go due after the due date, so that is known as the days past due. So, if I'm paying the balance, let's say 15 days after, so I've been already 15 days past due from the due date for that cycle, right? For that snapshot month. So if I have missed out my payment by 15 days, what it implies is that it took me 15 days to arrange for the fund which was however not there, implying that the sufficiency of the funds with this borrower is impacted, and hence there is a flag of increased riskiness. That's the reason why the snapshot delinquency or the delinquency for a given month is a very critical indicator for a borrower. Now you would see that now uh, in the current days, right? So when we do transactions every day, right? Now let's say in a month you have missed out a payment. Now if you have missed out a payment for a given month, the bank will reduce the bank can reduce your credit limit if you have missed out a cycle of payment and then repaid it later. So there can be a credit limit decrease which could be given to you if the time, I mean, if the time that we are talking about is a downturn that is ensuing in the economy. So then what can happen is a missed out payment can lead to a credit limit decrease by some percentage, whereas maintaining a healthy credit score can imply an increase in the credit limit increase. So assuming that my exposure remains 100, or let's say my exposure remains 1000, I can give, and let's say there are two people who has limit of 500 rupees. Now what I can do is I can always reduce the uh, limit assigned to one borrower to 300 and increase that of the better borrower to 700. And that's where the delinquency patterns come into play, because the patterns of missed out payments will give you a very big insight into how the strategy should be defined, how the risk management principle should be defined. So should a borrower be given a credit limit increase or not? So even if he's given a credit limit increase, what should be the percentage of the limit increase that should be given? So all these factors, they come from the delinquency based segmentation, right? So let's try to move a bit more deep into this. So while I talk about delinquency based risk, so what I'm talking about is delinquency as on the month, or what I'm talking about over here is a snapshot delinquency. Snapshot delinquency. So what is a snapshot? The snapshot is a month, is a time frame, a time period at which a data is recorded. So let's say I am recording, or I'm looking into the data for January 2016. So January 2016 becomes my snapshot. So so if an account has been delinquent as on Jan 2016, then for me he would be a more risky borrower than a borrower who is non-delinquent. So snapshot delinquency, right, is a very critical segmentation criteria for behavior scorecards. And when I so the question that we ask ourselves is obligor CD0, as on snapshot. So is he non-delinquent as on snapshot? Is obligor CD1 as on snapshot, right? So has the borrower missed out a payment as on a given snapshot month, right? So let's say there are two obligors who come up to you asking for a credit limit increase. Now you don't know anything about the customer, about the two obligors. You don't have access to any information whatsoever. So what you do is you ask him, or what he asks you is that I need a credit limit increase. So the only question that you ask him is, boss, are you delinquent or non-delinquent as on this month? If a borrower is delinquent as on a given month, then he is inevitably more riskier than a borrower who is not delinquent as on that month. Because so as of that month, the borrower who with the missed out payment is a more relatively more risky borrower for the bank, because the bank would interpret it this way that he is unable to make the payment and has become 3D1 because, and he has moved away from being a non-delinquent borrower because he could not arrange for the funds as on the due date. His due date has passed and it has taken time for him to arrange for the funds. Now, if that's the case, it means that his ability to repay the loan is impaired. Hence, he is a relatively more risky borrower than a borrower who has made all his payments for that month, right? So that's the reason why a CD0 or a current cycle of a zero cycle of delinquency borrower or a non-delinquent borrower is considered to be less risky than the delinquent borrower. Clear? So over here, CD0 borrower is always relatively less risky. Less risky than CD1. Than CD1. Right? Now, what is the advantage of this segmentation? The advantage of this segmentation is that it is a purely behavioral factor. So, if a borrower is missing out a payment or not, that delinquency pattern itself is a very good indicator of a is a very good behavioral factor, which is taken into account, and it is independent and it is very robust because it does not depend on the management decisions, right? Also, what you can see is that there is a clear difference in the bad rate that happens for each of the segments. So for example, it is generally seen that for non-delinquent segment, for snapshot non-delinquent segments, the default rate is not more than 3 to 4%, right? So out of the total number of accounts as on a given snapshot who are non-delinquent, only in the next 12 months, let's say 1% to 1 to 4% of the borrowers enter into default. The remaining 96% is fine. However, for the non-delinquent segment, for the delinquent segment, for the CD1 segment, you see more than 50% of the borrowers entering into default. So a borrower who is a snapshot telecycle CD1 or has missed out his payment in that given snapshot means his repayment ability is kind of dwindling, and hence there's a high chance that he may end up with a default, right? So that's how this segment is analyzed. However, when I talk about a snapshot delinquent, non-delinquent account, right, it is highly possible that, let's say we're looking at the data Jan 2016 and customer obligor A or account ID A is non-delinquent at as on that month, but there is a huge possibility that the account as on that may not be not delinquent, but he was delinquent or he may have been delinquent in the last 12 months. So the non-delinquent segment can further be risk risk differentiated to more homogeneous subgroups, where you look at that okay, if he's an account which is non-delinquent at snapshot, right? Non-delinquent at snapshot, then out of these accounts, how many accounts in the last 12 months have at least once been a CD1? So if your borrower has been CD1 in the last 12 months, at least in any snapshot month, then they would have relatively higher inherent risks of defaulting compared to borrowers who are non-default today and has remained non-defaulters over the last 12 months. So 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 that's so that's another level of segmentation that happens when we are trying to segment using a delinquency based information, right? When the behavior scorecards are being segmented based on their behavior risk, based on the delinquency behavior, because delinquency behavior is one of the most fundamental risk behavior of a borrower because it stems from the payment side. It does not stem from the billing side. So the transactors, revolvers, product types, everything, they were kind of coming from the more from the billing. The transactors and the revolvers were not right, so they were from the payment side. But the product type factors, they were more from the billing side. And if they are from the billing side, then what happens over here is that it is not really possible. Okay. Okay, so Mubashir has a question over here. Sorry, Mubashir, I missed out your question. Uh, your question is the snapshot time frame. Yes, Mubashir, a snapshot means a reporting date as on a given month. So if you are looking at a data as on, let's say, Jan 2021 or March 2021, then that's a time frame. That's a snapshot, right? So when we say snapshot, like when we are taking pictures, right, we freeze a freeze a photograph, right? So when we are clicking a photograph, we are freezing something. So similarly over here, for a snapshot is a month. It's a So if I'm looking at the data for Jan 2016, and then from Jan 2016 I want to know what happens in the next 12 months, so that is something which is what we call a snapshot, right?
Yeah, thank you.
Okay. Okay, great. So very quickly, let us look into the segmentation over here. So over here I have the snapshot. So set of all the records as on the given month. So over here one is delinquent. When I say delinquent over here, I mean only cycle one delinquent, because it can be cycle two or cycle three. It is only the snapshot delinquency. So whether a borrower as on that given month is one cycle delinquent or not. vis-a-vis whether he is non-delinquent. Non-delinquent. Now, while we talk about non-delinquency, this is further divided into two parts. Okay, wait. I'll call this. So this is known as the dirty segment. So what is the dirty segment? The dirty segment is those accounts which are currently non-delinquent, but has been delinquent at least once in the last 12 months. And the clean segment is the one which is never been delinquent. Right. So what is the advantage of doing this segmentation vis-a-vis the other criteria that is there? Now, one thing is that this is a payment based criteria. A payment based criteria. Now, given that it is a payment based criteria, so this is important or useful in risk based pricing of the secondary line of credit that will be given to them. So, the risk pricing can be done for the borrower. So borrowers who are delinquent as on a given snapshot and asking, let's say, for a credit limit increase or a credit limit decrease, or they're asking for a card upgrade, asking for new facilities to be added to the card, will be given it at a higher rate of interest, right? Whereas the borrowers who are there, right? So borrowers who are the good borrowers and they're non-delinquent, let's say non-delinquent and clean, and they have never been delinquent under all situations. So those borrowers will be getting the best rates. They will be getting the highest of the credit limit increases and so on. So these are so that's how this segmentation is actually very useful, right? And also, given that we have this segment and we are doing it a delinquency based segmentation, so there will always be sufficient volume across each of the segments. So there will be sufficient volume of customers across each of the segments, right? Now, most of the scorecards, especially when you are building a credit card a scorecard to so the behavior risk for a credit card, the delinquency based segmentations are actually very widespread, right? So this is the most fundamental form of segmentation, right? So this kind of further segmentations are observed in terms of vintages and seasoning of the accounts for regulatory models. But for scorecard models, these are the three broad segments that we generally have, right? Now, what we'll do over here is next is we'll kind of list out. There are two things that we need to address over here. Number one, why is it that I'm building an acquisition model or a behavior model? And second, where is it am I using these models to take risk management decisions? So acquisition scorecards or acquisition model, we know, are models which are used at the time of origination to get the borrowers to get the to assess the riskiness of the borrower at origination. The behavior scorecards are scorecards which are used to assess the riskiness of the borrower at the behavior stage. And out of these three, there are so out of these three, so out of these two, the final set of scorecards are the collection scorecards. So these are the three important scorecards that are there, right? So each of these scorecards are used for some purposes to manage the risk, right? And hence, that's where we'll talk about the risk management practices with each of these scorecards and how exactly is it that the business impact for these models are created. So, how exactly is it that you would estimate or capture the business impact of these scorecards, right? And what are the purposes? And how exactly is it used to, or what are the strategies of risk management associated with each of these scorecards? So that's the part that we'll talk about. When we are talking about strategies, we'll talk about the overview of building strategy models, what are the optimization problems that we face, and so on, right? Great. So let's start off with,
Uh, then my
yeah, 10.
this collection scorecard means a delinquency scorecard, right?
The collection scorecards would imply, so once a borrower has kind of started defaulting and not repaying back, right? Then what are the chances of collection, or what how much of money can be collected from a particular borrower based on his risk pattern? So that's collection scorecards. Collection scorecards is not the delinquent segment scorecard. The delinquent segments, the I mean the target variable for collection scorecards will be different. The target variable for the behavior scorecards will also be different. So when I'm talking about the delinquent segment is like cycle one delinquency. So he has just become from non-delinquent, he has just become delinquent in that month. It's not a CD2 or a CD3 delinquency, right? Now collect for collection scorecards, what we try to do is we try to figure out that how much of the money which is how much of what amount of money can be recovered from this exercise uh, from the from the borrower, right? Based on his risk characteristics. So there would be different segments of borrower based on their uh, characteristics, and then there would be strategies defined that for this borrower there should be calls, for this borrower there should be calls with mails being sent out. So that's what collection scorecards are about. Collection scorecards and behavior scorecards are not the same. Collection scorecard is only done for those accounts who have already entered the CD3 base, or who already satisfy the bad definition, right?
Okay.
because because the
Once the
base of
customer
the
move
sorry.
once the customer move to collection, after that the collection scorecard is building, right?
Correct, correct. So it would give me an idea about what proportion of balance can I correct from him. then how much of money can be collected from him in terms of collection scorecards, how much of this can be collected, and so on. So these are some of the important questions that comes up in a collection scorecards.
Okay.
Okay, so let us start off with the acquisition scorecards. What we know is that acquisition risk captures the risk of the borrower's profile at origination. Acquisition risk. Now, over here, the final output of an acquisition model or an acquisition scorecard is the acquisition score, or as I call people call it the underwriting score, or many people call it the origination score, and so on. The origination score. Now, what is the first strategy that we would take up, or risk management practice that we would do with this origination score? So the first ever strategy, the first and the most important strategy is the accept decline strategies. So are you willing to accept a borrower? Are you willing to accept a borrower or decline a borrower? Right? So are you willing to accept a borrower or are you willing to decline a borrower? So this is something that we want to understand. That's the accept decline strategy. So this is the first and the most important part that we generally do. The second part that we do is the origination score is used for risk based pricing of the loan product. Risk based pricing. Okay, we have the risk based pricing. And the third area where it is used is the limit assignment. The limit assignment. So these for a credit card, these are the three parts where the acquisition scorecard is used, right? Now the first, so the way it proceeds is first the question is that are you willing to accept the borrower? Yes. If you are doing so, what is the price that you would charge for the product? The third is what is the amount of limit that has to be assigned. So there is an accept decline. So these are the three broad strategies. Now, with the origination score and these strategies, how do I know that the strategies that the bank is taking up is an effective strategy, or the kind of accept decline strategies that the accept decline exercise that the bank is doing is being done better with the origination score than without it. So basically, let's say when a new model is being developed, right? So there has to be a business impact defined for that model. Now the question that we ask over here is that how do we assess that impact, the impact of the business impact of that model. The business impact of the model is assessed using something called a swap set analysis. A swap set, a swap set analysis, right? Through a swap set analysis. Now, this swap set analysis is performed both at the behavior level, behavior scorecard, as well as the acquisition scorecard. So, for the acquisition scorecard, it is done for the primary line of credit, and for the behavior scorecard, the swap set is tweaked to fit the the secondary line of credit requirement, right? So that's how acquisition scores are used. So now we'll go deep in now we'll take a step further to understand this origination scoring and how the accept decline decision is taken, and from there we'll go to talk about the same about the behavioral models, right? Okay, so I'll move to talk about the acquisition scores. Acquisition scores. The first strategy that we'll talk over here is the accept decline strategies. The accept decline strategies. Now, how does this accept decline strategy work? So, let's say P is the estimated probability of default, the estimated PD at origination. So, estimated PD at origination, and let's say P bar is your cutoff PD. PD that your business has decided or that you have decided through analysis. So you have the cutoff PD, right? So over here, if the estimated probability at origination is less than the p bar, then accept. So if the estimated probability of default is less than the cutoff probability of default of the borrower, that is, if the estimated risk is lower than the accepted level of risk, then there is a accept, right? Now the question that comes out over here is that how do I define or how do I calculate this PD model, this PD, or how do I identify what the cutoff is going to be? So that is something that we'll discuss in the next week's classes, not this week's session. So from there, and these PD scores are, or this PD model are kind of calibrated to PD scores, acquisition scores. So where if the PD is lower, the acquisition score will be higher. So if your estimated PD is lower than the cutoff PD, then your estimated score will be higher than the cutoff score. So either this is so either this is represented in terms of PD, or it is represented in terms of scoring. And we'll talk about how the scores are calibrated and so on in term when we discuss the model development side to it. So over here, the first question that comes out is an accept or a decline. So basically, if P is less than P bar, then it is accepted. However, if P is greater than P bar, this is declined. This is declined. Now, if this is now whether this accept decline is decline, that is whatever is going on through the scorecard. Now, the question that comes over here is this effective? To assess its effectiveness, a swap set analysis is designed. Okay. So what is the swap set analysis? So swap set analysis is an approach to build the to capture the business impact of an acquisition model. So it captures the business impact. The business impact. Right? So it captures the business impact of the model. So if I have built a new acquisition model and I'm taking my risk management decisions aligned to this, then it's called the swap set analysis. So it's very important that the impact should be the business impact should be assessed. Now, the business impact is being assessed, then the approach through which it is done is known as the swap set analysis. Now, how do you assess the effectiveness of a accept decline strategy, right? So there are 2 points that needs to be taken care of. Number one, has approval rates or booking rates being significantly impacted, or have they improved, has approval rates improved? has approval rates improved? But the second point is, has the riskiness in the portfolio gone down? So basically, if you have, you know, reduced. So basically, over here, there are two things. Has approval. So there are two aspects to this. One is that has the approval rates improved. So has the so you have built a new acquisition model, right? You have a new acquisition score. So is this newly developed model giving me or allowing me to improve my approval rates for the portfolio? And while I am booking the approval rates, can my model or is my model guiding me to approve the better borrowers? As a result, has the riskiness in the portfolio gone down? So acquisition scorecard would have or would put a certain impact to the strategy through two parts. One, if it is an effective strategy, the approval rate should go up. If the uh, model is a good model, then you should be booking borrowers with relatively better risk, right? And as a result, with relatively better profiles of borrowers, and hence the overall riskiness in the portfolio should go down, right? So that is what, so that's those are the two parameters of your acquisition model, and these two parameters are captured through the swap set analysis. How is it done? So what are the two questions? So how does swap set analysis address these two questions that has been incurred? So swap set analysis is essentially a comparative static analysis where first it holds the approval rates as given and checks the impact on the riskiness of the overall riskiness of the portfolio, and second it takes the overall riskiness as given and checks the impact on the approval rates, right? So there are two aspects to this. Okay, so there are two aspects to this. I'll just use the text box over here. So the swap set analysis over here. Sorry, is a comparative static exercise where addresses the following two questions. Number one, given the approval rate remains unchanged, changed, does the bad rate in the portfolio goes down. Second is given the bad rate in the portfolio remains unchanged. Does the approval rates does the approval rate remains unchanged? So basically, given that the approval rate remains unchanged, so assuming that you are booking the same number of accounts or the same proportion of customers, right? But does the bad rate in the portfolio go down? Are you booking, assuming that you are booking at the same rate, but are you booking better profiles of customers? So have you developed the scorecard in a manner such that you can measure, such that are you booking new, or the new profiles that are being booked, assuming that your, let's say your approval rate was 30%. At a 30% approval rate, the profiles that you are booking now, are the better profiles in terms of riskiness? So has the scorecard helped you reduce the riskiness in the overall lending, so in the particular portfolio for which you have built the model, right? So this is one of the most important impact analysis that we do once we have a certain scorecard. So basically, once you score all your accounts into your data, let's say you are trying to design a pricing, or you are trying to design a pricing strategy, or you are trying to design uh, uh, as a limit assignment strategy for the person, for your business, right? So the first step over there is to score the accounts and check whether the acquisition model that we had, that you have when at the time of your development, the business impact that it is giving, how closely is it replicating the business impact which was there when the model was developed, right? So that should be the first stage in building. So even if you're trying to build a strategy model, this is the first stage that you need to look at. So given the approval rate remains unchanged, as the bad rate portfolio in the portfolio goes down, so this shows that the riskiness in the portfolio has reduced. The model is allowing the risk manager to maintain with similar risk, better risk profiles. Right, so riskiness in the portfolio has reduced. So this is the first answer. The first question, that the new scorecard. Let's say I've developed a scorecard and I'm using that scorecard. So it shows that the scorecard has led to a reduction in the riskiness in the portfolio. So previously, those customers who were relatively less, more risky customers who are being booked is being rejected by this scorecard, and the customers who are relatively better profiles but were rejected are being accepted by this bank. So at that given approval rate, right, the percentage of the borrowers who are being given the loan is I mean the percentage has reduced, right? So is this part clear to us?
Tanmay,
Yeah.
how frequently banks are doing this short set analysis? Like once the model created, like in the during the what period they are
Now
doing this?
it can be, yeah, so basically given that it's a business impact, it gives the business impact, it can be used to monitor the business impact analysis as well. That given that the performance of the model, so if you are tracking the performance of the model on a monthly basis, you can also replicate this analysis at a monthly basis, check that on a month on month basis, is it that the performance of the model or the business impact that the model is giving is improving over time, or is it reducing over time, right? So basically, let's say you see that some of the model performance matrices has been in amber for the last 2 3 months, or let's say for the last 2 quarters, then one thing that you can always do is you can use this business impact analysis, swap set analysis, and check how the business impacts are looking like in terms of reduced bad rates and in terms of increased approval rates. And if you see the results are satisfactory, then you know that the model need not be rebuilt, right? So this is an analysis which is done in order to support the performance of the model, right? So there is no specific frequency of doing it. So let's say I said that let's say you are developing a strategy model for acquisition strategy model, right? So in that respect, what you do is you try to build these models. You go ahead and you try to build these models. And how do you? So basically, if you are trying to build a strategy model, first of all, you need to know that the model performance, the performance of the acquisition model, which is going to be a feeder in the strategy design, is working fine or not. So before you you aim to build a strategy model, you do your impact, your swap set analysis. So given that these are BAU models, they have to be used as, or these analysis has to be replicated or done in a manner to suit the risk management practices, the BAU risk management practices, but there are no hard and fast timelines or frequency under which they should be performed.
Yeah, good.
Clear?
Yeah, thank you.
But for regulatory models, if you are doing a particular analysis, there would be predefined frequencies of doing that. But for these models, for the BAU models, there is nothing like that. Right? So any questions? Okay. Now let's move to the next part. Okay, before I just begin with the next part, just quickly give me 5 minutes time. I'll just be back. You can also take a 5 minutes break.
This conference will now be recorded.
Hey, hi guys. Uh, okay, so let's get started. Share my screen. Can all of you see my screen? And am I audible to you both? And am I audible? Can everyone
Yeah,
hear
yes,
me?
it's correct.
Perfect. Okay, so coming to the swap set analysis. Okay, so the second part. So the second question says that given the bad rate in the portfolio remains unchanged, so basically you are accepting a level of risk. So if you are accepting a certain level of risk, has the acquisition or has the booking rate in your model gone up, right? So this shows that the profitability, not the profitability, the booking in the portfolio has increased if or given the risk manager is willing to a given level of risk. Level of risk, right? So these are the two most important. So this is how. So this is the first set of impact analysis that you do, that we generally do, right? Now from here, from the accept decline exercise, there are two things that needs to be taken into mind. That needs to be kept here in mind. So when I'm taking this accept reject decision, right, there are two kinds, there are two ways of accepts or declines. One is a score accept reject. Accept reject, right? So over here this accept rejection decision is done through scores. The second part is overrides, or as we call it, scoring through overrides or score overrides. Score overrides. So what is the concept of overrides? Score overrides play a very important part in the risk management exercises. So think about it. So this part is taken care of by the plain scoring framework or the model scoring over here, right? Scoring exercise. Now this part in the overrides. So let's say now there are two kinds of overrides. One is a policy override, right? So over here in the policy override, there are certain underwriters. So let's say there are certain business cases which may be score rejected, right? But it goes on to the underwriters for some specific purposes or because of certain specific risk profiles. And over there, it is up to the up to the underwriter to override that decision and accept or reject that borrower. Now this can happen because of certain characteristics of the profiles which are satisfying certain policies, right? So that's where the case of a policy override comes into place. the policy overrides come into play. The second is your system overrides, where the system, because of certain characteristics in the portfolio, automatically overrides the decision from an accept to a reject or a reject to a accept, right? Right. So it works like that. So think about a case like this. There is a borrower who has a very high affordability and is very highly reliable or has a very good credit history in his behavior, in his performance, everything, and based on that he has been a score accept, right? However, when while underwriting the loan manually, right, the underwriter sees that this customer has his family or his very next to kin family who is based out of any sanctioned list of nations. Now, given that he's based out, his next to kin is based out of the sanctioned list of nations, let's say Syria or uh, places like Afghanistan and so on, right? Then what they do is then the underwriter manually overwrites the application and rejects it. Guys, just give me a minute, huh? Okay. So as I was saying, that let's say this borrower has been accepted through the scoring mechanism, but when the manual underwriter looks into it, he sees that this borrower has someone who is, or his next to kin who is based out of Syria, and he is someone who is very very frequently he's a visitor in Syria and so on, right? So and he is very well connected with the family. Now, given that he has connections with the sanction list of with people in who fall in the sanction list of nations, so therefore, what they do is they they kind of say that so then the manual underwriter overrides that acceptance decision and rejects the application. So because he falls under a set of policies, he falls under sanction list of policies where he is manually removed from the underwriter from the list. Now it may often happen that so there is a borrower whose demographic informations may be mismatching, right? Or he may be a borrower or there may be a borrower who has been applied for the loan, who has applied for the loan, but then finally what you see is that he has two date of births mentioned in two different parts, and hence by the policy his age becomes a bit dubious, and hence he may be rejected the loan because of inconsistency in documentation. So all these fall under kind of policy overrides, right? So once the borrower has kind of policy override, so once the borrower has kind of policy has overrides, uh, or he's kind of overridden, right? So at an acquisition stage, or when when an accept decline decision is being taken, these overrides play a very important part. Now, what the overrides kind of tell us is the that or if you have it is very important to compute the percentage of these overrides or override percentages. Percentage of overrides. Now, when I'm computing this percentage overrides, so the overrides have an implication on the model usage, because the more or the higher the override rates are, the greater are the model usages. I mean, the lower is the usage of the model, the more limited is the model usage. So, if you see the override rates are increasing over a period of time, there are these high override rates, you know that the model usage is going down. So, ideally, you would expect when the monitor, so if you're continuously you are monitoring your models, right? After a point of time, you would observe that when the model performance is going down, the override rates are increasing, right? Now these override rates will also have, or increasing override rates will also have certain implications on the strategy of the acquisition strategy that the bank takes. Let's say that I have my segments, right? Let's say I have my segments like relationship and non-relationship customers, right? And then I see that the non-relationship customer segment has been ramped down by the business, so the model that is no more or has very limited usage over there, right? And most of the scores are being overridden scores. Hence, when we are kind of devising the strategy, whenever pricing strategy, or or this acquisition score enters into limit assignment, then and it is very important that you have an override flag, and the nature of the override just to identify that the pricing that you are doing. So is it because of the riskiness associated with the borrower's profile, or is it because of some external factors like some business decisions had been taken for which the model usage is now limited and overrides are taking place? So basically, if there are overrides into the banking business, so when you design on a strategy, when you look into when you're computing ROIs and stuff like that, that's where it is very important to ensure that, so ensure that you are actually, so basically your strategy itself, so when you, let's say you are doing a limit assignment strategy, so then that can be done separately for accounts which are being score accepted and accounts which are being score overrides, right? So that override rate is actually very important, because there is a huge set of manual intervention which happens when there is policy overrides. Now, and it is also very important to understand the distribution between the policy and the system override rate and the overall override rates. Right now, what is the system override? A system override generally happens for a factor, for a case, let's say there is someone who has been score rejected, right? But one of the columns show that it's a premier by wealth account. So basically, this borrower maintains huge volume of wealth with the bank, even though his income is zero. So by the statistical affordability variables, the statistical model is giving you a low score. But given that the system has a field that is a premier by wealth account, so this the model cannot operate on that segment. So before, so if there are any abnormal accounts or there are any exclusive accounts into the data that is removed before model development, so they are not applicable to them. But when the model is running onto them, is being implemented and it is running for all the accounts, so there in the system there would be a field of premier by wealth, and it would be that if it is premier by wealth, then the account is not running through the scoring mechanism, it is being directly being accepted for the card that is being approved, and it has to manually underwritten. Therefore, system overrides would can help you convert score rejects to accepts and score accepts to rejects. So let's say there is a borrower who has been score accepted, right? But the system has a field of staff. So basically, let's say he's applied for a product which is only eligible to the staffs of the bank. Then, in such a case, if the account is not a staff account, the system overrides the score, overrides the final decision from an accept to a reject, right? So the percentage, the higher the percentage of the overrides is in a data or in a model, shows the limited usage of the model. So it is very important that when the model is being built, right, the scope of the model is well defined, right? Exclusions to the scope is properly defined in the data, and and the scoring mechanism should not be applied to those excluded accounts, right? So that would, say for example, let's take this case of Premier by Wealth. Now a Premier by Wealth account is like on less than 1% of the total portfolio, right? So if your model is is scoring those accounts, it would be a reject, and then given the system, it would be a accept. So ideally your model should not enter. So if an account is Premier by Wealth, or there should be a set of exclusions which are applied, to which the scoring mechanism will not be applied, because if it is applied and then overridden through the system, even if it's a system overridden, so if it is written through the overridden through the system, then the challenge that comes over here is that the challenge that comes over here is that the override rates will get impacted, right? So your models override rate, and hence that would have a reflection on the model usage. So when the model oversight committee, or you know the stakeholders take a look at the model usage, it would reflect as a negative impact on the model usage. Hence it has to be ensured that we use the model very judiciously, the scoring is done very judiciously. So there should be a set of factors which are excluded. Apart from that, there will be certain system overrides and policy overrides as well. That's fine, but all the key exclusions should be appropriately applied, and the model scope should be appropriately defined before the scoring of the model happens, because it is very important that the overrides are monitored and captured gradually, because an increasing override rate can imply that the model performance has deteriorated, and which can impact the model usage. So that is something which is there. So after this accept decline decision, so for all the accounts which are accepted by the bank, right, now the next question is that what should be the limit that should be assigned, and what should be the price of the product, right? So the first thing that we need to understand over here is how is exactly the limit assigned, right? Limit assignment and product pricing. So we'll talk about the product pricing and the limit assignment. Now when you are assigning the limit, there is a whole set of factors which will enter into this, because now from here the acquisition strategies appropriate would begin appropriately, right? So let's do something. Let's take a pause here for the day today. Let's not uh, start with the strategy and then leave it half ended. So we'll discuss the strategies next week, next Saturday and Sunday, right? We'll discuss the acquisition and the behavior strategies, and how these strategies would help us next week, right? So in the meantime, please access the recordings and go through them, uh, and revise the recordings, and we'll catch up next week. Thank you guys. And if you
Tanmay,
need any assistance, if you are caught up anywhere, please feel free to reach out to me. Yes, Mubashir, please tell me.
are you busy? Like, can I talk a 5 minutes to you?
Yes, please. Sure, I'll just pause the recording.